everybody, it's Rebecca Eunice from Eunice & Associates CPA, and welcome back to our video series comparing the tax proposed plans coming down from Hillary Clinton and Donald Trump as it compares to current tax law. Listen, as of the shooting of this video, both Democratic and Republican national conventions are done, so the hoopla for that has settled down, so maybe the name calling will settle down. What do you think? Probably not. All right, anyway. So what we wanted to do is, we know now that the campaigns will certainly be focusing on unveiling their tax plans and the details that go along with it now, okay? So we wanted to finish our series out with explaining to you the differences as it stands right now with long-term capital gains and dividends, okay? So let's just start out with the definition of long-term investment. What is that? Under current law, that is any investment held for more than 1 year, and you will be subject to preferential gain rates, okay? Under all three plans, there is a 0% bracket, okay? Under current law, if you are a single taxpayer and you have adjusted gross income up to $37,650, or you're married filing joint up to $73,000 of adjusted gross income, you stay in that 0% capital gain category. So it's great news, right? You got a capital gain coming down within that, you're at 0%. You're not paying tax on it. For Hillary Clinton, we're going to keep her brackets pretty close to current law because up till now, that's how they've been reporting. Again, possibly be changing that. However, for purposes of this video, we're going to keep her at these tax brackets under current law. Under Donald Trump's plan, you're at 0% as a single taxpayer for a little bit longer, okay, up to $50,000 of adjusted gross income. Married filing joint, you're more than double staying there, up to $150,000 of adjusted gross income. That is a huge jump and a great incentive, okay, for married filing joint taxpayers to have capital gains and to hold them long term to stay in a 0% category. I think that's great news. All right. The 15% bracket, though, is where most Americans sit because under current law, as a single taxpayer, from $37,651 up to $416,000 of adjusted gross income, you're in the 15% mark. You're in the 15% gain rate. $73,001 up to $467,000 of adjusted gross income for married filing joint. You're also in the 15% category. So most Americans are sitting right here, 15%, okay? Hillary is at 15%. This is I'm going to get there, so stay patient with me, but we'll call her 15% for now. Under Donald Trump, you're up to, single taxpayers up to $150,000 of adjusted gross, $300,000 if you're married filing joint, keeps you in his 15% bracket. Now, he shrunk that a little bit. He grew this one, shrunk this one, but still most taxpayers are going to be sitting in this 15% mark, all right? Then we bump up in excess of $416,000, in excess of $467,000. You are in the maximum long-term capital gain rate of 20%, okay? Under Donald Trump, anything over $150,000 if you're single, $300,000 if you're married filing joint, you're still in the 20%. So anything over that stays at 20%. Under Hillary Clinton, a little added layer for you, for your liking. So she has this tax going on here for couples. Okay, so to me that means married filing joint. If your adjusted gross income is $456,000 or more-ish, like that's like, you know, change, or more, you are in the top taxable category, okay? What she's saying to you is that long-term, by definition, 12 or more than a year, doesn't really apply to you. So under 1 year, your capital gain rate under Hillary Clinton is 39.6%, that top tax bracket. For years 1 to 2, okay, so that technically is long-term, you're still being taxed long-term capital gain rates at 39.6%. Then you start dropping. You don't get to the 20% preferential capital gain tax, long-term capital gain tax, until guess how long? in excess of holding that investment in excess of 6 years. 6 years! Like, okay, so you have real estate or you have stocks. Well, we're all watching the cycle because there's a cycle in the real estate market. There's cycles in the stock market, right? We're watching the cycle so we can maximize our investment and sell when the time is right. Now, under her plan, if you're in that top tax bracket, you'd pay attention. You'd pay also attention to your losses, talk to your tax advisor or your investment advisor to help balance and compensate that out. But this is crazy. And on top of this, all of this, my friends, there is something called the net investment income tax. It's this slippery little tax that kind of kicks in, and it's already part of current law. And it says that single taxpayers with a modified adjusted gross income of $200,000 or more, and married filing joint modified AGI of $250,000 or more, oh, you're subject to this tax. 3.8% on top of your long-term capital gain rate. This is like, my blood boils, my veins pop. Like, well, who does this, right? Tax on top of tax, and we layer it, and then we owe more and more. But guess what? Under Hillary, if you're down here, okay, you're paying 36%, say you held it 2 to 3 years, you're paying 36% plus 3.8%. And how about this? Under Hillary Clinton with the 3.8%. If you earn more, if your income is $5 million or more, you get an extra 4% surcharge, another layer on top. I understand what you're going to say. You say, Becky, you know what? How many people really are in that category? But that doesn't matter. The point being is it's tax on top of tax on top of tax. There's like the incentive of investing in America or investing in investments here is deminimized, right? Where Donald Trump's take on the net investment income tax, let's just get rid of it. He wants to get rid of it. And you know what? I think that's a great idea because when this tax came into play, it hurt several of our clients because several of our clients are right here. And if they're 200 or 250 or more, they hit it. And it doesn't take a lot to get there. If you have a piece of real estate that you bought for $250,000 and you depreciate it to zero and you sell it for $250,000, boom, you're there. So the thing is that we get rid of it, and I have to tell you, it's an incentive to invest. And I think it's actually trying to simplify what we have going on right now. So you obviously need to stay educated through this campaign, guys, all right? Because this is good. This is our baseline. That's where we're starting. But I guarantee you this thing is going to blow up and become more and more cumbersome as their campaigns progress towards November, okay? And as promised, we will keep you posted on every layer that comes down. And as these changes, get laid out, we're happy to bring them to you. We certainly tell you to talk to your BFF CPA or your tax advisor, most certainly, to know how all of this is going to affect you directly so you are educated on the candidates and who you will vote for, all right? So I hope this video served you. And if you have any comments or questions, please post them below. And as always, I look forward to seeing you in the next video.